Hello, my friends. My name is Tomasz Wiśniewski, and I am a head of research and education at Axiory. Please let me tell you if you can hear me. Please let me tell you on the chat that everything is okay with audio, and we will be able to start our webinar. Excellent, loud and clear. Thank you very much. So, my friends, hello, welcome to our webinar. The date is quite surprising because most of the brokers say that they don't do anything around Christmas holidays. On the Forex market, it's actually a dead season, like the volatility decreases, there are no more interesting price movements. But we think that we should make something for you. It's our gift for you. We will give you know-how. We will teach you how to trade. So, my friends, let's start without further ado. Let's start our webinar. It will last 1 hour and a half around. It should last 1 hour and a half. And really brace yourself for a nice journey on the Forex market from the very beginning to, let's say, semi-intermediate knowledge, semi-intermediate stuff. Obviously, before I will start teaching you, you need to know who is teaching you, because, well, you don't want to get a random knowledge from a random guy. It would be the best if a person who is teaching, who is giving you knowledge, was a professional trader, was a trader himself with a big experience on the market. And thanks to Axiory, you have this kind of person, you have this kind of help. So again, my name is Tomasz Wiśniewski. I am a professional trader. My idea, my system, my strategy is based on price action. I'm doing swing trading, which means that I have my positions open for a few hours, few days, 2 weeks, 1 week. So this is my horizon. This is the horizon of my investments. I have 10 years of experience on the market. So I started slightly after the great financial crisis in 2007, 2008 on the stock exchange. So it was a perfect time to start trading on a stock exchange because the prices were really low. And it really helped to get into this business. Okay, I can see that we have someone from Mars. That's really amazing that we have a good reception there. But a lot of people from Nigeria. So hello, my fellow Nigerians. I've been in Nigeria, I think, around 3 times. Yes, I will have to look at my passport for the visa to Ukraine, to Nigeria, but I've been there 3 times. Already, consul in the embassy in Poland knows me very well. He's my friend. I've been in Abuja, Lagos, Kano as well. In Abuja, Lagos many times, 3, 4 times during those times, coming back and forth. Hello to my fellow friends from Nigeria. Yes, this webinar will be recorded and you will get the recording. You will get the link after the webinar from our sales representatives from our account managers. So again, I started 10 years ago, and obviously I'm trading myself. I have an account, I'm trading on the real market. But apart from this, I am also teaching. I'm sharing my knowledge. I don't like this word teaching. I prefer to say that I share my knowledge, my experience. I've been really sharing this experience all over the world. In the meantime, I'm also giving interviews to the radio, TV, newspapers, etc. So it's how it looks like. If you didn't receive the link to the last webinar, please contact your account manager. He will provide you the link. So no problem with that. Okay, my friends. Yes, I am still a trader. I am trading right now. Actually, on the second screen, I have 3 positions opened. I just closed my position on American dollar to Mexican peso. Before the webinar, I can see profit 2,500 euros, which is pretty nice profit. I kept that position open for the past 6 days since 11th of December. It was a short position on American dollar to Mexican peso. So, my friends, I am actively trading. And I am sharing my view, again, experience, trades, everything. Always when I travel, I'm meeting with fellow traders and I am sharing my statement, etc. So, my friends, let's start the webinar. If you are the clients, traders who attended our previous webinars, if you attended the webinars for beginners, I'm sorry, but this will be the same content. So if you attended the webinar about the recession, for example, or others, then it's going to be a different webinar. But if you attended the webinar about Forex basics, then this is the same webinar about the basics of the Forex market. So let's start, my friends. Forex market. Forex is a shortcut from the foreign exchange, and Forex is a shortcut itself, which is FX. So this is a place where investors, speculators, importers, exporters, they exchange, so buy, sell currency. It is absolutely the biggest financial market in the world, and it has the most dynamic growth. Who can tell me, my friends? Now is a question for you, because I want you to be active on this webinar. Again, if you have any questions, please ask. Who are the market participants? The biggest 4 groups of the market participants. Please tell me on the chat. Banks, yes, Kennedy, sir, you are right, banks. What are other groups of market participants? Please share on the chat. Hedge funds. So I would say, in general, financial institutions, banks, okay? Retailers, yes, retailers. So you and me, I am also a retailer, despite having 80,000 euros on my account. It's still really low amount of money. I am still a retailer. And the importers, exporters, beautiful. That is a good answer, my friends. So you have central banks. Here, banks, mostly government central banks. You have commercial banks, hedge funds, financial institutions. You have retail traders, so me, you, and you have importers, exporters. These are market participants. 20, 30 years ago, the biggest group of traders were importers, exporters. Now it's financial institutions. About the retail traders, what do you think? How big is this market? What's the percentage of retail traders on the market? Are retail traders 20% of the market, 51%? Who can tell me? What is your thought on this? 5%. Any guess? Any other guess? 15%. My friends, John Smith, so an average trader, a retail trader, is about 3.5, 3.8% of the turnover on the market. And Japan is undisputed champion in this category. A lot of people in Japan trade on their own, trade money on the Forex market. At the very beginning, the cost for retail traders for us was too high. So small investors were not attractive for this market. But later, brokers decided to gather all those trades from retail traders, which lowered the costs. And now we can enter the market as a retail traders, and we are responsible for 3.5, 3.8 turnover on this market. This is the map of the world, and it explains you where and when do you trade. So you can trade all over the world. And we trade 24/5, not 24/7, because the market is closed on the weekends. But my friends, the fact is that Earth is round. Okay, some people believe that Earth is flat, but the Earth is round. So most of the people here on this webinar are from GCC countries, so Dubai, Qatar, and from Nigeria. So with people from Nigeria, we share the same time zone. So I'm based here and you are based here. Some of the traders are from GCC countries. More or less, we share the same time zone with Dubai. I think there is a 3 or 2 hours difference than a Central European time. Anyway, for us, trading starts on Sunday evening because that's when the Monday morning is in New Zealand and Australia. Okay, because that's how it works. So it's Monday morning, and Australians and New Zealanders they start trading. For us, it's still Sunday evening. Then Asia joins in, big financial centers, Tokyo, Hong Kong, Kuala Lumpur, Singapore, etc. Then GCC countries, then Africa and Europe, Frankfurt, London, Amsterdam. Then it goes to the North America and South America, and it goes on and on and on. And that's why you trade 24/5. Trading ends in the afternoon of Friday afternoon American time, which means that there's late evening European and African time. This is how it works. And also, where do you trade? Everywhere, guys. So it's not like this that you have a local stock exchange and you can only, when you are a person living in London and you want to buy shares of, I don't know, Rolls-Royce or Tesco, or Rover, let's say, you can do it only on the local stock exchange, on London Stock Exchange. No, on the Forex market, there is no central institutions. There are group of institutions all over the world, like brokers, investment banks, clearing houses, liquidity providers, and they are connected with the network. So it's not like there is a central stock exchange responsible for this, but it's more like a network of smaller institutions. Okay. Let's continue. What do we trade? Please tell me, what can we trade on the Forex market? Obviously, you can trade currencies, right? This is the most popular. You know that you can trade currencies, but thanks to the contract for difference, so CFDs, you can trade different instruments. Yes, gold and silver, you're right. So precious metals and in general commodities, because also you can trade oil. And as for Nigerian traders, trading oil is very popular because obviously Nigeria is producing a lot of oil, and you know about this. Currencies, yes, but also thanks to CFD contracts, contracts for differences, many brokers, Axiory, propose also give an opportunity to trade indexes, but also shares, for example, and cryptocurrencies as well. So I can see that some of the people say that we don't have audio. Please, if you hear me, please type that audio is okay. From my experience, I know that it's unfortunately the problem on your end with your internet connection. So it cannot be like this that some of the people receive the audio and some of them not. If it happens, it means that the problem is unfortunately on your end. Okay, how big is the Forex market? Because we may say like, yeah, it is huge, but how big is the Forex market? As you can see, it's around $6 billion every single day. That is a turnover on the Forex market, and it's growing with a small decline in 2016, but it's growing. Those numbers are taken from the report from BIS, Bank of International Settlements, and this data is the closest that we can get. Because again, this market is decentralized and it is really hard to get a proper data for this, but this is the closest we can get. So this data is relevant for us. What do we trade in terms of the currencies? So you have single currencies here, and the most popular is the American dollar. Then the second most popular is euro. Then the first most popular is Japanese yen. And then you have EME. What is EME? Who knows what is EME? It's here. What is EME? These are emerging markets currencies, so basket of emerging markets currencies, okay? As for the single currencies, then we have British pound, Australian dollar, Canadian dollar, Swiss franc, Chinese yuan, Hong Kong dollar, New Zealand dollar, Swedish krone, Korean won, Singaporean dollar, Norwegian krone, and Mexican peso. But on this market, you trade currency versus currency. So you trade currency pairs. With one currency you buy, other you sell, like euro dollar. If you buy, it means that you buy euro, buy dollars. So you have currency pairs. The most popular is euro dollar, dollar to euro. I'm sorry. Then you have Japanese yen to dollar. Then you have cable, which is a British pound to American dollar. The nickname is cable. Who can tell me why the nickname is cable? Why British pound GBP slash USD is named cable? Any answer? I'll give you half minute. Okay, there's no answer because at the very beginning, the data was transmitted, okay, from London to New York by a cable which was laying on the bottom of the sea. That's why British pound to American dollar is cable. Then you have the basket of emerging markets currencies to dollar. Then you have Australian dollar to American dollar, etc., etc. And you can see that almost all here are the currencies are quoted against dollars. So dollar is the reserve currency, is the most important currency in the world. Only three pairs without dollar are British pound to American dollar, yen to euro. I'm sorry, British pound to euro, yen to euro, and euro to Swiss franc. Who can tell me what are the reasons why dollar is the reserve currency? Why American dollar is the most popular and most widely traded currency in the world? Please tell me on the chat. Yes, so one of the reasons is obviously the status of the United States as the world superpower which won Second World War, won Cold War, and the reason for this is after this, well, actually during the Second World War at the end, when the United States was sure that they will win, that Allies will win the Second World War, will win with Nazi Germany. They started to create the new world order, right, after the Second World War. So America created World Bank, International Monetary Fund, and they created all this system in Bretton Woods, this system based on the American dollar. So, for example, World Bank, what is doing? World Bank is borrowing money to third world countries, okay, to countries which are less developed. Those money are in what? Are in dollars, okay? So this is one of the very many examples how this is controlled. Everything what we have now, all the global trade system is controlled by America. Maybe you do not realize this, but all trade routes from China to America, from Africa to America, from Africa to Europe, all trade routes are controlled by America. All the crucial trade points like Hormuz Strait, Malacca Strait, where all the trade is happening, is controlled by America. Okay, so this is why American dollar is the most widely accepted, traded, used, and respected currencies in the world. But it's slowly changing. There is another global superpower which wants to take the control of it. And this superpower is, who can tell me? Which superpower is trying to challenge America? This is, I'm waiting for an answer. China. Thank you very much. China is trying to take control of the world right now, trying to challenge the United States hegemony. European Union is very weak, is being, let's say, attacked by its own bureaucracy, by its own problems. It's just the fact that the union of so different countries has a lot of problems. So union of the similar countries make sense, but if you have a very poor countries together with very rich countries, they just have different interests. So that's why Europe has its own big problems. Okay, let's continue, my friends. So as we said here on the previous chart, you have currency pairs. What does it mean in case of, for example, euro dollar? You have a base currency, which is euro, and you have quote currency, which is dollar. And it goes for all of those. So base currency in the cable is British pound and quote currency is dollar. Base currency in American dollar to Japanese yen is American dollar, and quote currency is Japanese yen. And it goes on and on. You have two prices on the market. Okay, so when you open a platform, you can see that you can buy and sell at the same time, and for this you have two different prices. The chart that you can see is drawn with one price, which makes it a bit confusing at the very beginning, because if you see the chart being drawn by one price, you may get this feeling that there is only one price on the market, but no. Chart is drawn by a bid price, by the lower price, but there is also an ask price, which is used equal amount of time. Because if you open a position with bid, you close it with ask. If you open with ask, you close it with bid. It's just that this ask price is not visible by default on the platform. Obviously, you can't turn it on, but you need to change it in the settings. Okay, so bid price is the price to sell a currency pair, and ask price is the price to buy a currency pair. So you always buy with the higher price, you sell with the lower. Because if it was the other way around, you could have risk-free investment. You would buy with the lower, sell with the higher instantly. In 1 second, you would make profits. Okay, so it makes no sense. You buy with the higher price and you sell with the lower. That's how it works. And difference between those two, difference between ask minus bid is spread. So spread is the this difference between those two prices. As we said, ask is 99.9% of the time higher than bid. So ask minus bid gives you spread. This difference between those two prices on popular volatile instruments is really low. This difference on a less volatile, more exotic instrument is a bit higher. Let's see this. This is a screen from a platform, and what you can see here are charts. You can see the terminal window where you can see trades, and you can see the market watch window where you can see the list of instruments. And here you have a bid and ask price. Bid is lower, ask is higher. Here on the chart, you can see that the chart is drawn by a bid price, but here you can see also an ask price, which you can turn on the settings. Here you have a sell button and a bid button, and those prices are here, 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 here. Okay, so this is how it works. About the position size. It is very important for you to know the correct position size, because the position size, how large is your trade, is crucial for your money management and for your future profits on this market. So general position size is a lot. One lot means that you have 100,000 of the base currency. So the first currency. So one lot of euro dollar means that you are responsible, that you are trading, that you are taking care of 100,000 euros. One lot of British pound to American dollar means that you are responsible for 100,000 pounds. And one lot is a standard position size. But it does not mean that you have to trade with one lot. It's just the standard position size. You can open 0.1 lot. You can open 0.2 lots. You can open 0.38 lots. You can adjust it for your needs, for your money management skills, for your risk control rules. Okay, so you can adjust it as you want. Only the fact that the one lot is a standard position size does not mean that you have to use it. You use the position size that you can afford. And the leverage. I need to tell you about the leverage because it's one of the things that that differs the forex market from the other markets. So the leverage allows you to open much larger positions than without it. So for example, I am now writing an article about trading in silver and gold. If you buy physical silver or gold and you want to buy an ounce of gold, okay, you have to pay $1,500 to buy an ounce of a physical gold to keep it in your pocket or in your safe, let's say. But if you want to buy 1 ounce of gold on the platform, trading the contracts for difference, trading the futures, you require only 1% of this if you have a leverage of 1 to 100. Okay, because in terms of if you have the leverage 1 to 100, 1% controls 100%. $1,000 controls $100,000, which is a great solution for smaller accounts, which is a great solution for traders who have small amount of money. Well, not small, but smaller. This is a great solution for the people who want to learn, who want to start trading. So if you just start trading and you're, for example, a student and you have only $100, fair enough. You can't start with this. And thanks to the leverage, with $100, you will be able to control $10,000. Okay? And from this, it makes sense that you can control with this amount of money, this amount of money. Okay, so leverage is a great thing because with for the people with smaller capital, then they can provide control of bigger capital. But obviously, if it allows you to have bigger wins, bigger profits, it also there is a risk that it will give you bigger losses if the losses will occur. So keep that in mind. Okay, long position, short position, uptrend, downtrend. The principle of trading is really easy. You buy when the price is low, you sell when the price is high. Okay, so here is a downtrend. Here is an example of a downtrend. The price is making lower lows and lower highs. In general, the price is going lower. Okay, so this is the environment, this is the situation where you should look for the short position. And here on the contrary, you have an example of an uptrend. So the price making higher highs and higher lows. And as long as this situation continues, the best option, the better option would be to buy, to open long position. About the long position, my friends. Okay, here is just an example, but thanks to this example, you will have a general idea of how it works. You have a long position, which means buying. Okay, you have a deposit of $1,000, which is a standard deposit, let's say. But you're using the leverage of 1 to 100. So your trading capital is really $100,000. With this capital, thanks to this leverage, you in reality control this amount of money. So let's say that with this, you open one lot of euro dollar and you are buying with the price of 120. And you're closing your position on price 120.65, which means that you are making 55 pips. And to be honest with you, 55 pips is not a lot. To catch 55 pips on the market, it takes you sometimes few minutes. Let's say for the purpose of this webinar that it will take you few hours to earn 55 pips. Let's say how this hypothetical situation works out for you. But first, let me explain you the short position. Later, I will tell you how much it brings. So short position means that you are selling. The same deposit, $1,000, same leverage, and you control the same amount of money. You sell with 120.65 and you close your position with 120.10. And here in this case, you also make 55 pips. What is the pip value? Okay, because I tell you about the 55 pips. Okay, but what does it mean? 55 pips in terms of the one lot means that it's $10 on euro dollar. It's $10 on British pound to American dollar. It's 10 francs on one lot of American dollar to Swiss franc. So the pip value is taken from the quote currency, not from the base currency, but from the quote currency. So here, in terms of the one lot, you know that one pip is $10. So you add 55 pips. It gives us the profit, 550 pips. Imagine this, my friends. You have $1,000 with this leverage. So you control this. You open one lot. You get 55 pips, which, as I tell you, can take you a few hours. And in few hours from $1,000, you can make $550, which means that in few hours, you can make more than 50% of the profit. I think it sounds pretty interesting. I think it sounds pretty awesome, to be honest with you. The thing is that opening one lot with the deposit of $1,000 is super risky, and I do not think it is a good idea. This risk that you're taking is just too high. It is possible, it is doable, traders do this, but me as a teacher, as a mentor, as an educator, I totally do not recommend this because it's simply too risky. I prefer trading with low risk, with the idea of respecting your own money. The same goes with a short position. It's everything is the same apart from you're selling, not buying. So here you're selling, you're earning 55 pips, which in one lot and leverage 1 to 100 gives you $550. So this is how it works. Maybe you have some experience with trading on the stock exchange. Okay, maybe you do. Maybe if not having an experience, you just know how to trade on stocks because you watch some movies about this, etc. Okay, so if that's right, maybe we should compare Forex market and trading stocks because people tend to know more about trading stocks, trading shares, than they know about trading Forex market. So what are the differences? Well, variety and number of instruments. So on the Forex market, as you know, you thanks to contracts for difference, you also have, like, for example, gold, which is pretty awesome because I love trading precious metals. About trading times, you have you can trade 24/5. You're not limited to the opening hours of your stock exchange. Liquidity and volatility. So Forex is less volatile. Many people will tell you that Forex is very volatile, which is not true. Forex market is less volatile. Stocks can change 3%, 4% a day without any news whatsoever. Currency pair like euro dollar usually do not exceed 1% daily change. Okay, Forex market is more liquid, but is less volatile. Try to remember this. Don't let anyone to scare you that Forex market is bad because it's so volatile. No, it is not. What makes it look volatile is this leverage. Leverage makes you, gives you the ability to earn a lot of money or lose money in short amount of time. but it does not mean that Forex market is volatile. Provisions and costs. So on the Forex market, you don't pay any commission. You don't have costs. The only real cost of trading is the difference between buy and sell, this spread, but spread is really low. Much bigger spread you will get on the stock exchange. Regulations, there are different regulations because Forex market is decentralized, so it can be regulated by any other country. Factors influencing the price of the asset. So when you trade on the stock exchange, you trade shares. Well, the share price of the company is affected by the financial situation of this company, right? On the Forex market, it's more about macro economy, about global interest rates, about the global sentiment, okay? So it's a big picture on the Forex market, which implicates the type of the analysis which you are using. So in my opinion, to trade profitably on the Forex market, all you need is a technical analysis, which is much better for you because you don't need this special financial knowledge, okay? For you, you just learn a few principles of the technical analysis and you will be fine. Ability to make profits on the price decline. This for me is a huge benefit of the Forex market because when there will be a recession, when prices are going down, stock traders are losing money, but Forex traders can make money. On the Forex market, there are no recessions, there are just occasions. So a Forex trader can go long, Forex trader can buy, Forex trader can sell at the same time. You can go both ways. And you can control your position. You can modify your position when you want because it's open 24/5, but also you have a user-friendly platform on your mobile. So you can trade while having a drink on the beach, while relaxing with your friends. And the difference is that you have a leverage, which I explained to you before. Trader's Dictionary. In order to understand different webinars or analysis, you need to have understand the special wording of this. So of the traders, because we do have a special slang. So you have bulls. Bulls, the demand, so those who want to buy or want to earn on the asset when the price goes up. You have bears, so supply, those who want to sell or want to earn on the asset when the price goes down. You have greenback, which is an American dollar. You have cable, which is a British pound to American dollar. And you have sterling, which is British pound itself. You have Swissy, so Swiss franc. You have Loonie, so American dollar to Canadian dollar. You have Aussie, Australian dollar to American dollar. You have Kiwi, which is New Zealand dollar to American dollar. You have Hogs. The hawk is a policymaker or advisor who wants the interest rates to go up. Dove is happy with the interest rates when they are low. You have also scalping, for example, which is a strategy which is very popular among beginners. So I guess that some of you are thinking about scalping, about becoming a scalper, which I don't think it's a good idea. But in general, scalping is a strategy based on short transactions with high volume, and you want to catch small, frequent movements. And you have carry trading, which is a long-term strategy based on the benefits of the positive swaps. So buying currencies with higher interest rates. Like, for example, my trade in American dollar to Mexican peso, that was a short position. So I was buying Mexican peso, which has much higher interest rate than American dollar. So overnight, I was receiving small amount of money just for having this position, just for keeping this position open, thanks to swaps. Okay, so this is one of the strategies. Okay, my friends, now we will move to the second part of this webinar, where I will explain you more practical approach to trading. So brace yourself for another 40 minutes of knowledge. My friends, how to make profits on the market? Well, many traders, they try to complicate this process, and in reality this process is not complicated at all. This process is really easy. You have to buy when the price is low, you have to sell when the price is high. And on the other hand, we said that that traders can make money when the price goes down. So you sell when the price is high and buy when the price is low. Simple as this. There is no magic here. Seriously, my friends, you know this chart from the previous slides. When you see the uptrend, you try to buy here, 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 or here. And when the trend is a downtrend, you try to sell here, 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 here. Sometimes you will sell here, but if there is a downtrend, it means that in general the prices are going down. So if you sold here, but you are okay with the trend, you can make profits with time. Sell high, buy low, sell high. That's when you go with the trend, uptrend or the downtrend. But sometimes on the market there is no trend, okay? So there is no trend, but I need to answer this on the chat. What if everyone wants to sell high? Yes, this is also popular. So this is an uptrend. Traders want to sell here and buy here. They want to have this position, okay? But the thing is, the problem is that in an uptrend that we are having here, what you should do is you should buy here, buy here, buy here, or buy here. You should always go with the trend because it is always more likely that the trend will be continued. That's the difference. In the uptrend, you try to find a good occasion to buy. In the downtrend, you try to find a good occasion to sell. You don't try to anticipate the trend change because it is really hard to anticipate the trend change. Okay, sometimes there are periods when there are no trend. This is range trading, trading in range. This is a sideways trend. So the price has an important resistance. The price has an important support and is going from the support to the resistance. Some people like to trade in a range. They sell when the price goes to the resistance and they buy when the price goes to the support. That's also an option. Look at here. Here is an example of a range. There is a horizontal resistance. There is a horizontal support. When the price got here and somebody sold, profit, 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 profit. Here you have support, support. When the price went here, profit, profit. And here eventually a loss because the price broke and then broke again. That's one of the approaches. Another approach for trading is channel trading. In order to draw a line, what do you need? You need 2 points. if you want to draw a line. Have a first point and second point. You can draw a support. You have a point here and a point here. You can draw a resistance. From here, you can draw a support and a resistance. And then, when the price is locked inside, you can use it in your favor. So the price gets here, then starts to go down. The price approaches support. And then what you can do here is you can expect that we will have a bounce and the price will continue to go higher. Here you can expect that the traders will take profits and the price will go down. And it goes on and on. Really? Does it go on and on? We will see on the next slide. Sell here, buy here, sell here, buy here. The thing is that it's a channel up, so the price generally goes up, right? So selling in an uptrend is not the best idea. The best idea is buying in an uptrend. Look, there is a resistance here, here, and there is a support here and here. So buying here gives you profit. 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 Buying here gives you short-term loss but long-term profit. You are just joining the trend because this trend is generally pushing the price higher. As we know, we can go both ways on the market. So there is a resistance, there is a support. You can as easily buy as sell, you can as easily sell as buy. Price reaches the resistance, which you know from those 2 points, and then you can sell, and it gives you a nice fat profit. Okay, now I will explain you, I will show you a few interesting trading patterns, trading formations, which will allow you to trade profitably on the market. Trading formations, why they work, is because the price is moving in certain ways, was moving in certain ways, and will be moving in certain ways. Price is making patterns. People are attending financial bubbles. They were and they will do this because nothing changes. Human behavior, human psychology does not change over time. That's why we had a bubble on Bitcoin, for example. That's why we had a housing bubble, which created a great financial crisis in 2007-8. Okay, because our behavior does not change and we do not learn from the history. This is why we tend to repeat our actions. If we repeat our actions, it means that we will trade the same way. If we trade the same way, it means that the price will make patterns, is making patterns. So smart people for the past few hundred years, they found those patterns. They named those patterns. They labeled those patterns. And now we can use it in our favor. First patterns is head and shoulder that I want to show you. Head and shoulder, why? Because it has head, it has left shoulder, it has right shoulder. Then there is a neckline, and breaking the neckline gives us a sell signal. Okay, so there is a head, there is a left shoulder, head, and right shoulder. The thing is, it brings us a sell signal not because it has a fancy name and it looks like shoulder, head, and a shoulder. The reason why it is signaling us a sell signal is because the trend has changed. So bullish trend is when the price is making higher highs and higher lows. When the price starts to make lower lows and lower highs, it means that there is a trend change. So it is better to open a short position. Simple as this. Let me show you. There is an uptrend, there is a left shoulder, there is a head, there is a right shoulder, then the price makes lower low, lower high, and there is a trend reversal. Crucial in this case is a neckline. Very often after breaking the neckline, we test the neckline as a resistance. Broken neckline gives us a test of this as a resistance. Okay, take that for granted. It's happening most of the time, not all of the time, but most of the time. Sideways trend, but from this position the price is going up. Higher high, higher low, higher high, higher low, higher high, higher low, lower high, lower low. Here there is no low, but we already know that this lower low will happen because we broke the previous low. So you don't have to wait for establishing the lower low. If you know here that this lower low will happen because we already went lower than the previous low. So that's why breaking the neckline gives us a signal to sell. And there is a lower high and then the price goes down. Inverse head and shoulder pattern. The same, but goes for the other trend. So head and shoulder is in an uptrend, inverse head and shoulder is for the downtrend. Left shoulder, head, and right shoulder. Broken neckline and an upswing. Usually, guys, technical formations, they tell you that something can happen with a higher probability. Okay? That there is a higher probability that something will happen. It does not tell you that something will happen, that it is certain, that it will happen 100%. No. Normally you open a chart and it's 50-50 for the price to go up or down. Okay? But with this technical formations, it's no longer 50-50. It's 55-45, for example. But for some people, it's enough to trade. For some people, it's enough to open a position. And for me, it's enough to open a position. Because trading is all about low odds. Odds of one scenario happening. Okay, so technical formations, they increase the odds of success. Let's put the head and shoulder into practice. Look at this. This is a great example because it has both inverse head and shoulder and head and shoulder. There is a downtrend, New Zealand dollar to American dollar. Left shoulder, head, and a right shoulder. Then there is a trend reversal. As you can see, the trend is broken because the downtrend line is broken, and the price goes up. But then meets a head and shoulder formation. And from this, there is a breakout of the neckline, and from this, the price should go down. We have a newcomer. I came late, so what's up? Nothing, just having a webinar. What's up with you, man? Why are you late? Okay, it's 59 minutes of the webinar and you're late. Not good. But don't worry, man, you will get a recording of this webinar later. Yeah, don't be late, man. Money, they don't want you to be late. Once the occasion is gone on the market, it's gone. You don't change the occasion. That's why market will teach you not to be late. But in Axiory, we give you a chance, so you will receive the recording of this webinar. Again, Inverse head and shoulder formation, my friends. There is a downtrend, there is an inverse head and shoulder formation, left shoulder, head and right shoulder, breakout of the neckline, and there is an uptrend. Okay, inverse head and shoulder formation, it works. And it does not work because I tell you so. It does not work because some guy found out that it works. It works because it's based on the human emotions. It works because it's based on the human psychology, and it will work because it's how we are constructed. Whether you believe it or not. You don't have to believe it, guys. It's not up to me for you to force you to believe in this. I'm just sharing my experience and I'm just showing you what works for me. There is another pattern, triangle. Everybody knows how the triangle works, looks like this, like this. There is a formation called triangle. Okay? Why? Because it looks like a triangle. But here you can see that I didn't show you if the price will break to the upside or to the downside. Why I didn't show you? Because with triangles, it is not clear if the price will go to the upside or to the downside. And then you may ask me, okay, Tomasz, so why are you showing us this formation if it does not work, if it does not predict if the price will go up or down? And my answer for this is because it's not about predicting. Trading is about reacting. Trading is about your reaction to what will happen. All right? So triangle tells you that you soon should see the breakout because the volatility decreases. And you soon should see the breakout. And once the breakout happens, you trade. You don't guess here. You don't guess. You don't guess. Why? Because you are not here to guess. You are here to make money. And as a trader based in Poland, in Dubai, in Nigeria, in Tanzania, you don't care if the price will go up or down. Totally, you don't care about this whatsoever. You are here to make money, to use those movements. Do you care, my friends, if the American dollar to Swiss franc, when it will be in this situation, do you care if it will go up or down? No. So that's why when the price is in the triangle, you wait for the breakout. Once the price breaks the upper line of this formation, there is a bigger chance that this movement will continue and the price will go up. In the case that the price will break the lower line of this formation, there will be a bigger chance that the price will continue to go down. So here, a smart trader, wait for the breakout. You don't try to predict, you just wait. Once there is a breakout, you trade. You trade either up or down. You either buy or sell. In this case, we have a symmetric triangle and we have a breakout to the downside. If there was a breakout to the upside, we could buy. Here is a breakout to the downside. So here you can see the trend continuation. Trend before this sideways trend, before this triangle was a downtrend, and the price breaks to the downside. So there is a downtrend. Here you can see trade reversal. So trend was bullish. There was this triangle and the price reversed. So it can go both ways. The price can reverse or the trend can be continued. There are triangles which are promoting the breakout to one side. Symmetric triangles, they promote the breakout to the both sides. But ascending triangles, where the resistance is horizontal one and the support is dynamic one, they promote the breakout to the upside. Right? Why? Because you can see the rising pressure on the resistance. Rising pressure, sellers are weaker, they cannot push the price lower anymore, and eventually you have a breakout, an acceleration of this movement, and a nice upswing. On the other side, descending triangle is where you have a horizontal support, and then there you have a rising pressure to the downside, and eventually a breakout, and the price goes down. So this is a descending triangle. Okay, now, how do you feel, my friends? Are you tired? Is it a lot of knowledge or not yet? Please tell me on the chat. Not yet. You feel good. Excellent, my friends. Excellent, my friends. I am super happy to hear this because I have more for you. If you were tired, I would stop now, but I'm very happy to hear that you're interested and you're following it. Thank you for your kind words, my friend. So I carry on with the candles. Candles, my friends. So you saw those charts. They are presented with candles. For some of you, it may be a rocket science, and I'm not surprised because candles can be confusing, but I will make them much easier to learn for you. So a line chart, how the line chart is created. You have the closing price of the day, another day, another day, another day, another day, another day. Then you connect those dots with a line, and then you have a line chart. But if you want to repeat the same chart with candles, it will look something like this. Okay, something like this. And on the line chart, you have one price. On the candlestick, you have four prices. 1, 2, 3, 4. 1, 2, 3, 4. 1, 2, 1, 2. Here only 1, 2 because those two prices play the role of four prices. If it's confusing, wait a little bit. Here comes the explanation. So candle gives you four prices: opening price, closing price, the lowest price in that particular time, and the highest price in that particular time. Let's say it's 1 day of trading. In 1 day of trading, you will see something like this. This is a line chart representing 1 day of trading. So this is like 9 a.m., 10 a.m., 10:30, 11, 11:30, 12, 3 p.m., etc., etc. From this, you can create a candlestick chart. I told you, four prices. You take the opening price, you take the closing price, because it's a 1 day. 1 day. You take the highest price, you take the lowest price. And from those four prices, you can create a candlestick. There's a question if I can do mentoring. Sure, my friends, I did mentoring before with great results, and I want to do mentoring as well in Axiory for you guys. But give me some time. I need to establish all the processes here, and I will do mentoring program for you. Seriously, give me some time, but in next year I will do mentoring, which most probably will be for free because I make money on the market. I don't need to charge you for mentoring. So stay with Axiory. because if you will come here just for one webinar and you will leave us, you will never know that I'm doing mentoring. Okay, so you have to stay with us. From the opening price and the closing price, you create a body. Body is this thick part of the candle. If the price went higher in that particular time frame, and it did, the body is usually green or white. If the price would decline, the body would be black or red, usually. But you can change colors by yourself. Here you have the highest price in that particular time frame and the lowest price in that particular time frame, which are shadows, wicks. We can call it lower wick, upper wick, shadow, lower shadow, etc. Or a head or a tail, different names. That's pretty much it, how the candle is created. Let me show you one more example, which we'll use later. We start trading here. The price goes down, meets a support, gets rejected. Traders find this area attractive. They start to buy, and the price reverses and goes higher. Because here there was this support. This is a crucial information. And candles, they have a trading pattern for this. They have a trading pattern which gives you a trading signal. So this kind of an action creates a hammer. There is a body on top because opening and closing price creates a body. And there is a tail on the bottom because that's the lowest price. That is a hammer, right? It looks like a hammer because here you can draw a person. With a hammer. It can be Thor from Marvel comics and movies with his magical hammer. Okay, so it is a hammer. And this is, thank you, yes, this is truly a great piece of art. I think, I don't know if you heard that recently they sold a banana stick to the wall for hundreds of dollars as a piece of art. I think my Viking with a hammer is worth much more than this banana. Anyways, here's another example of the candles, how they are created, which I created for you. And here's another example, how it works, more professional way, but also done by me. And there are certain candles that can give you certain trading signals. So for example, Marubozu. Marubozu is a plain candle in one direction. So what it shows you is that from the very beginning here, the price was going up, or from the very beginning, the price was going down. Simple as this. Let's see how it works. So we have a nice uptrend, price making higher highs and higher lows, and eventually the price breaks this support. And such a strong breakout of a Marubozu candle gives you a sell signal, and it is a beautiful sell signal because the price goes down. There is another Marubozu here breaking support. There's another Marubozu here breaking horizontal support. This one is making breaking dynamic support. What Marubozu shows you is a dominance of one side of the market. It shows you that one side of the market took over the control for now, and maybe it is a good idea to join them, especially that this Marubozu is breaking important support or resistance. And it always requires a lot of power, a lot of force to break certain support or a resistance. Okay, hammers and shooting stars. Hammers, I already drew you, but shooting star. What this shooting star is showing us is, for example, there is a resistance. We start here, the price goes here because there is this high, gets rejected and goes here because it's a close. So you can see shooting hammer shows you the rejection of a support. Shooting star shows you the rejection of the resistance. So it shows you that the price was too high. It was too expensive to buy. So traders decide to sell. Why it's a shooting star? Because it looks like a shooting star. And it's a Christmas time. So this motif of a shooting star is really, really popular. Shooting stars here and here. This one is super important because this shooting star happens on a resistance. Resistance is set once, second time with a shooting star. So it means not that the shooting star is present here, so we should sell, but it means that there is a rejection of the resistance and the price was too high. Traders don't want to buy anymore. They prefer to sell and the price starts to go down. Simple as that. There is a shooting star here as well. Hammer shooting stars. Downtrend, hammer, uptrend, correction, hammer again, uptrend, shooting star, correction. As you can see, only one candlestick pattern can give you a proper trading signal. Okay, this is really important. Hammer shooting stars, downtrend, hammer, uptrend, shooting star, downtrend. Only one trading pattern can give you a trading signal. Engulfings. Engulfings are really popular. So far I showed you one candlestick formations, now two candlestick formations. So formations which have two candles. First one is bearish engulfing. The price goes up, there's a nice bullish candle, then there is second one which overlaps it entirely and it creates a good environment for drop, especially when it's happening on the resistance. And here is a bullish engulfing, so the price goes down. There is a bearish candle, there is a second one which overlaps the first one entirely, and then there is a reversal and the price goes up. An example, upswing, engulfing. First one does not work. They need a second one, which reverses the trend. Uptrend, engulfing, reversal. Downtrend, engulfing, reversal. Uptrend, engulfing, reversal. Simple as this, guys. This is pretty nice and clean setup. As you see, trading is not a rocket science. I didn't show you super complicated trading techniques. It's pretty simple because it's based on the human psychology, which is pretty simple, but you just need to understand this. You just need to want to understand this. If it's too confusing at the very beginning, can I get this? It might be because we've been together 1 hour, 20 minutes, and I already gave you a lot of knowledge, and at the very beginning, it can be too much. But my friends, don't worry, I have a Twitter account which I advise you to follow, Wisniewski Effects, or follow the Axiory Twitter account where I share my analysis. For example, the one that I wrote for, I'm writing for FX Street. I write for FX Street, FX Empire, Investing.com. So the biggest forex portals in the world. I post there my trading ideas. I post it later on Twitter, so you can check this out. Also, on Twitter, I post my analytical videos. Guys, every day I am posting 3 best trading occasions on the market. Can you imagine this? Absolutely for free. Okay? Now, not because I'm away, but once I'll be back at Poland, I will start to record those videos again. So follow me on the Twitter and you will get those videos with 3 best trading occasions on the market. Instagram, I don't have Instagram. I used to have Instagram, but it's too complicated. Not the usage of Instagram, but your life becomes complicated when you have Instagram, especially in terms of the private life. I don't know what, I hope that you know what I mean. If you have a girlfriend, you know. Okay, my friends, follow us on the Twitter. Facebook, I also don't have Facebook. Facebook became too political recently. I quit Facebook 3 years ago. I don't like how Facebook treats the privacy and political issues. They are biased. So no, thank you for this. Only Twitter, my friends, only Twitter. But if you didn't get a link to the previous webinar, if you want the link to this webinar, if you want to ask us even a stupid question, because there are no stupid questions, but if you want to ask us any question, please do it on support@axiory.com. Okay? Ask us there, because there are a bunch of guys waiting for those questions, waiting for an opportunity to answer and help you. So write to those guys. They will be more than happy to answer. Also, a disclaimer, remember, I am not giving investment advices. I am not giving recommendations. When you will see my trading videos, I am not telling you you should buy here or sell here because it's forbidden by law and I don't want to go to prison. What I am doing is I am sharing my knowledge. I am saying what I am doing. Never, ever, ever, I will never tell you that you should buy or sell, because it's not my job to do so. Okay? Any questions, my friends? We have 2 minutes for questions. Please ask. If you are shy, don't worry, I am shy too. You can ask our guys on the mail, support@axiory.com. Kennedy, thank you very much for your question. We all know that big boys control the market, so how can we spot the activities? This is a brilliant question, because it shows I know how you think about this, because I spoke with thousands of traders, so it's not a surprise. So don't think that if someone controls the market, you cannot make money on this market. Because what retail traders think is that they have to go against the big boys, against the banks. In reality, you have to go with them. So don't try to fight with the dragon. Don't try to fight with the shark. Try to join them. That's why you don't need to analyze the market trying to predict the future. You analyze the market and try to join the trend. Let's say it looks like this, and this whole movement is created by those big boys. It's manipulated. It's created by Goldman Sachs and HSBC. But what it means is that there is an uptrend and the prices may going higher. making higher highs and higher lows. It means that those big boys from Wall Street are earning money. It means that they are greedy. They want to earn more money. What retail traders do, they try to sell here, sell here, sell here, sell here. In reality, what you should do is to buy here, buy here, buy here, buy here, buy here. Try to join them. That's why we spent here an hour and a half to teach you that you have to join them, not fight with them. Thank you very much. Case closed. What's my advice on quick trades? My advice is to don't do quick trades because they don't work, and quick trades are the best way to make quick losses. Thank you very much. Case closed. What are the benefits? What benefit with this trading to Axiory? Well, benefits to trade with Axiory, I can tell you, because we have lightning fast execution and you have an access to top-notch education right here, right now. How to develop own trading strategy. Learn, develop, access the knowledge that we are giving you, all those strategies that we are sharing, all the webinars I did before. Ask your sales manager, he will give you, and thanks to this, you will be able to develop your trading strategy. Also in January, we start our very own cycle of 9 educational webinar where I will show you everything. But if you want trading strategy right here, right now, use candles, use trade when you have a hammer and a shooting star. Trade breakouts from the triangle. Trade everything what gives you an edge over the market. Head and shoulder formations, for example. Okay? This. Okay. Don't regret of not coming earlier because you will get the recordings. Don't worry. Don't worry, so you will get the recordings. Okay, my friends, we don't have any more questions. Hour and a half of proper trading knowledge. I hope that you are happy with this. Please, after the webinar will end, you will be able to rate this webinar, write a comment. So please rate it. And I'm not telling you that you have to rate with 5 stars like on when driving with Uber driver. No, rate it as you feel. And thanks to this, I have a proper feedback. So if you think that this seminar was bad, please tell me on comments, rate it as a bad. If you think this seminar was awesome, rate it as awesome. Thank you very much, guys. It was a pleasure to be here with you. You're a very good group of traders. I can see that there is a lot of enthusiasm in you. And I hope to see you again in the future. For those who celebrate Christmas, Merry Christmas, my friends. For those who don't celebrate Christmas, happy holidays, have a good time. Spend it with your family, loved ones, everyone that you respect, love, like, etc. Spread the good vibes in the world and enjoy everything that you do in life. Thank you. I love you too, my friends, and all the best. See you.